This is Samuel Koh once again. Welcome to the 7th installation of the HQ Financial Planning Conversation, Alan Lim exclusive. Once again, one of the emphases that we have been always talking about in this series has been about whether we are relevant, how to keep ourselves relevant in this coming future. So just share with you guys before I start a very short story. This morning I was cycling, and then during the rest time, I was in a cafe, and sitting right across the bench was a lady, right? And so because of the proximity, we started chatting. And she actually shared that in October, she lose a job, right? She lose a job. And actually, she's a truck driver. Right, working in the mining industry, right, in Western Australia. But because I didn't hear quite correctly, and then later I clarify. Actually, she's not going to lose a job next October. She actually lost a job in this October. That means just a couple of months back. Okay, and the reason is because of what self-driving truck. So when I heard that, I actually feel the feeling was actually very profound, because, we have been talking about this week in, week out, and then I thought self-driving truck, I know about self-driving truck, but I thought it's something that's like going to be quite far in the future. Wouldn't happen yet, So when I heard that, it's like, it really hit us. And here is someone sitting right in front of me telling me that she actually just lost a job because of that. So I think coming back to our industry, financial services industry, the message I have been very focused on of late is that there is an urgent need for financial practitioners to really raise your game. But in what area? I think mainly in two areas. Number one is in terms of knowledge. Number two, you got to combine that knowledge with a system that really support your business in a real way.
Yes.
Okay,
Yes,
so without further ado, right, I want to once again welcome Alan Lim to this conversation, and he's going to be sharing with us about MAS report that just came out, and some of the key figures inside the report that will be important for financial practitioners to know and to understand, and like all the previous sessions, we will then pivot into a case study. This time, the case study is going to be about the case of intestacy in estate planning. Okay, so without further ado, Alan,
Okay,
it's
Ken,
very
thanks.
good to see you again. And this time, one thing that's really different about you is the hairstyle. You didn't change your hairstyle, right?
No, I just got a haircut yesterday. So my wife was so angry about that she demanded me to wear a jockey cap when I'm out. Okay. Now, thanks a lot. It's on the very fast. It's on the 7th installation. I didn't know that.
7 really.
Thanks.
Yeah.
Thanks for inviting me back on this conversation. Now, what happened was every first week of December, 1st December, MAS actually published a financial stability review that map out what are some of the how vulnerable or how strong are the household finances and corporate finances is in Singapore. So as a financial advisor, I think it's important for you to, or for us to know the actual happenings in the country that we practice our trade. All right. So this financial stability review is a report that I make it a point that every year I will download it and then spend about 2 days over the weekend to read through it. All right. So I will do a share screen just to share my thoughts for this, or some of the insights that we can share from this part. All right. Ken. Now, this is the entire financial stability report. Actually is about 111 pages. All right. MAS does condense it into a series of slides, a very readable PowerPoint slide on their MAS website to let the public know. Actually, MAS did online presentation of this particular slide to some of the stakeholders in the financial industry. All right, the banks, the fund manager, the insurance people. It does. All right. Now, what happened is that this is a report that published by the Macroprudential or Surveillance Department, the Economic Policy Group. Now, Singapore is one of the few countries in the world that mass amount of data is widely available on the internet space. The same data that we can get it, sometimes we take it for granted. No? Now, personally, also sit on the education board of the Asia Pacific Financial Service Association. So again, the contact with people practitioners from Thailand, Philippines, Vietnam, all right, Taiwan. Now, the same level of information sometimes is not readily available in those countries. No? So sometimes if you don't have the information, it's very difficult for you to manage. When it's very difficult for you to manage, it's very difficult for you to plan ahead. Now, all planning involving the future. Let's put it this way. All right, all planning involving the future. So we must base our planning on certain data, on certain evidence. Otherwise, we have been building a castle in the air like that. All right, so we got to watch data. Now, watch data, there are two ways of looking at it. When we look at data, most data are going to give you disturbing insights. So as a professional, we could look at the data as it is, not what we wish it to be. All right, as it is, then we plan around it. Okay. Now, let's take a look at this report. This part here. What happened was Singapore, we are going through a pandemic situation, COVID-19. 100 billion from the reserve has been taken out to help Singaporeans, to help the Singapore economy. There is no certainty whether will the economy recover. All right. Or rather, I put it this way, there's no certainty the economy will recover next year. All right. It's a number of, it will sure recover, but it is the amount of time it takes.
Yeah.
All right. So this is a very serious situation. So therefore, with these facts, what are some of the impact on household financial position and corporate financial position? Right. So this particular report come out certain indexes. I'll just show you. Yeah. These are the data that this particular report talk about. These are all hard data. As you read it, you will find it disturbing. But as a professional, we just had to take a look at that. Okay.
Yeah.
Assets is a blessing, but debts you got to pay back. So corporate indebtedness as a result of COVID-19, not surprising. High corporate indebtedness that went up. Raising a sovereign debt, that has to do with Singapore. All right, also increases. Capital flow volatility in emerging markets remain volatile. Now the recovery is going to be uneven. The recovery could also be unequal or uncertain as well. So therefore, these are some of the things that we're going to take note. Which sector your client is and which sector perhaps you are in. Now take a look at this part here. All right. Now these are hard data. The exact figures you can read it from the report. Let me exact figures. What is FVI? FVI is a financial vulnerability index that MAS came out with. All right, to draw certain conclusion from the data that they have on a year-to-year basis. The corporate balance sheet are relatively resilient, though leverage risk is elevated. Leverage is what? Borrowed money. The use of borrowed money. All right. You can see the leverage risk from Q2 2019 and Q2 2020. Not much changes. Not much changes. All right. Now let's take a look at this part here. Corporate liquidity risk, maturity risk. You can see some of the arrow are red color pointing up, meaning to say that year to year the risk actually go up. Maturity risk.
I see.
All right. So this is corporate, meaning to say that if a client in the business sector, do prepare that some of your clients is actually facing potential financial issues. Right? Let's take a look at household debts. Household services burden are manageable. All right. The leverage has popped up. All right. You take a look at this the household debt situation. The household debt situation. The blue color bar. From 2010 all the way to 2020. The amount of household debts in Singapore is going up. Now, debt, if you manage it properly, is good. If you manage it properly. But the thing is, debt got this seduction capability. seduction. Meaning to say what? If you don't manage it well, you thought that you're purchasing an asset. But if you do not manage the debt well, you might not only lose the asset eventually, you might even become bankrupt. So therefore, the debt, the figures on debt is one of the data that as a financial advisor, that we watch it very closely. And as a financial advisor, you also have to help your client to watch out his debt level. His debt level. Right? I show you some last slides over here. Overall household balance sheet are relatively healthy. So far, still healthy. All right. You can see the household net worth and the household cash and debt. The blue color is a cash and deposit. You can see the red line is the debt. So far, right now, the cash and deposit are more than the household debt. This one's the overall picture. But how does it apply to your client situation? That perhaps on a yearly basis, you can also issue a financial sustainability report to your client on your client situation. How much debt your client is having, how much cash your client is having, number one. And number two, if your client met with a debt situation, all right, how much capital liquidity your client's estate have. If your client get into a critical illness situation, how much capital, how much liquidity your client have. Do some simple report to show to the client on a yearly basis.
The question I have, Alan, is this, right? This particular report is released December.
December.
And, COVID happened early in the year.
Yes, correct.
And because there's a lot of government support, right? Job support scheme and all that. So a lot of the real issues are not really surfaced yet, isn't it?
Not yet. It is not yet. All right.
So perhaps in 2021, the same report in 2021, we were beginning to see the problems, both in corporate as well as household figures, right?
Yes, correct. So this one give you a broad understanding of what the Singapore situation is. In fact, if you run through the report, the 111 pages, that PDF report, even break down into pieces, that among the household debt, how many percentage is used in terms of buying property? How many percentage of the debt is in buying a car? How many percentage is in credit card? Give you a very good insights. So the reason why this report is important, number one, it gives the financial advisor an understanding of a Singapore broad picture, number one. And number two, the data on debt is very important because sometimes as a financial advisor, when we design a financial planning solution, it accidentally becomes a financial planning problem. I'll give you one example. When I first entered the industry 22 years ago, you want to buy insurance policy, you got to use cash to buy. In today, sometimes you don't need to come out cash, or you come out some part of cash. The rest of it you can actually borrow from the bank. It's called premium financing. Usually it's big policy.
Yeah.
Big policy means to say the amount you borrow also big. I always mention, you come out to the fundamentals the same. The moment you come into using debt as one of the strategy for your financial planning solutions, if you don't handle it well, your financial planning solutions could turn out to be your financial planning problem. I'll give one example. If you don't handle your debt well, you could be borrowing money to buy an insurance policy. The debt can't be paid for whatever reason. The policy, for whatever reason, once been surrendered by the bank, the cash value is insufficient to cover the debts. The bank got every right to sue the client for bankruptcy. So this is some of the situations. Sometimes as an advisor, we just got to think through a little bit deeper during our review. Now, before we review client's financial plan, we need to review ourselves also. It means to say we take out the client's file, we could go through the client situation ourselves first before we report to the client. Correct? Now, that part of it, sometimes we got to think through. I mean, the advisor talk to the heart. And it's best that you got another counterparty of similar knowledge and experience to give you the impartial checks to ensure that you don't skew overly to one direction. But that in our industry is very difficult because our industry sometimes, as a financial advisor, is a lonely journey. But I mean also because of the way that we are being compensated. So sometimes we treat our fellow advisor as a competitor rather than co-worker.
I see.
This is one of the problems that we face in our industry, the financial industry.
How do you think?
Mm.
How do you think this situation can change? Actually, just to share with you, several years already, I have been sharing this idea with some leaders. It is also coming from the client's point of view. Am I right? Now? If you, as my advisor, help me draft out a very good plan, okay, and the plan, the premium that I put in place is sizable and all that, right? In fact, the stakes are higher.
Yeah.
And my question to you is this: if something were to happen to you, you the advisor,
Yes.
what's going to happen to my plan? Will my plan still be in place, or is there a redundancy in place whereby someone can take over the case, right? And still be able to continue the conversation. You see that with doctors, am I right? If the doctor leave the clinic, the case file is still there, right?
Correct.
So I think this is one of the very real issues. So I actually told them to kind of collaborate, group together, and in fact, if the client have an emergency, there's a number to call, and then they are able to reach someone else. I mean, you could be going for a holiday for 3 weeks, for that matter, and then during that 3 weeks, something urgent happened to the client. Who is the client going to call, right?
Correct.
Yeah.
But
so the need for collaboration, I think, in the coming future might just become a very practical need, right?
It is. It is still evolving. Maybe in the table of collaborators, one of the players is AI. I firmly believe in it. One of the players is going to be AI.
Yeah.
All right. So yes. So this one is still. Now the thing is, sometimes you're being forced into. I just give you one example. 2 weeks ago, I had a appointment with a co-advisor. An ultra high net worth case. It's very interesting. I didn't know this problem exists until I went to the trustee office. All right. So what happened was the client is a elderly gentleman. He's quite old already. He went through the heart surgery, so decided to do some plan giving before he passed away, because he worried that there will be some family dispute. He got many children, he got many grandchildren, so he want to pass down. So the consideration of one of the core asset that he want to set up a trust. Why is that so? The core asset sits inside a land in some part of Singapore. On this land, he purchased the land. In 1960s, he purchased the land to build his factory and a warehouse to store some raw materials. And he became one of the biggest player of that raw material. As Singapore progresses, he also progresses. Okay. Now, right now he want to sell the land because he felt that his children are not so keen in running the business. And he also admit that most of his clients, because of him, will transact the business. So right now he's already he's preparing for his departure to heaven. So he wanted to sell the piece of land, which amount to about 20 million. He wanted to use that 20 million to set up a trust and to start to do some distribution. So he want to set up a trust. So therefore, we went to the trustee office together with one of the children that he identified to be his spokesperson, because he speaks Hokkien. All right, so this daughter is supposed to translate the English into Hokkien to him. Okay. So we went to the trust. Of course, in the trust deed, as we drop out the trust deed, the trust deed, you can say something like this. We will give so-and-so, the advisor, the first right of refusal to be the financial advisor, assisting the trustee to manage the 20 million. Which advisor don't want that? That means it's a confirmed sales, no? Meaning to say, in the next 2 to 3 years, when the old elderly gentleman pass away, when they sell the land, the AUM, asset under management, is 20 million, no? So as a financial advisor, we just have to plan what are the product, what are the what portfolio, unit trust portfolio, or what to hold this 20 million. It can be insurance policy or whatsoever, but you need to justify. But the thing is, the trustee also turn around and look at the financial advisor. All right? And also look at me. I'm one of them. Okay. Even though you say that, look, Alan and so, even though in the trust deed, he mentioned that both of you are the preferred financial advisor, you're given the first right of refusal. Yeah. But as a trustee, I will also need to do due diligence check on you. No, I will ask you what is your processes. No, what is your qualification? Now, how much asset have you managed? What's your track record? No, asset we call it AUM. How much AUM you right now already have? All right. So past 3 years, what is your track record? That means your AUM say assuming is 20 million. How much return you have made vis-a-vis a benchmark? If it's negative, vis-a-vis a benchmark. All right, because COVID-19, that kind of situation. And what qualification you have? And one of the question is succession. No, what processes you have? If either one of you not around. Now, 2 questions on this meeting. This is what we call a high net worth case. Which financial advisor don't want? Every financial advisor hope to be in this situation.
Yeah. So now I'm curious.
Yes, but
what's your answer?
Let me highlight to you which financial advisor is prepared to play this game. No, you can't just go and say that you want to win the World Cup without improving your processes. No, if your whole life playing basketball, court football, you say you want to win World Cup without changing your process. I think that always remain a dream. That's it. What is a plan, you say? So therefore, that really strikes me that in future, this is the game going to be. As the mass market, some of the business is increasingly being replaced by, say, a technology or becoming commercially not feasible for financial advisor. I'll be very blunt. I mean, this is a video. I'll be very blunt. As a financial advisor, are you seriously interested in dabbling in MediShield plan? The medical insurance, use CPF to purchase one. This is a heart-to-heart talk, no? You know the revenue is extremely low. You know your amount of work that you do is extremely high.
Yeah.
The amount of potential liability because of a lack of understanding of the product is equally high. So it might not become commercially viable for advisor. So therefore, high net worth is not a choice. No? Sometimes it's inevitable you could go to that direction. But as you go to high direction, the trustee will ask you. This is what I mean by in future, the financial advisor might not face the ultimate consumer of the financial product. No, he might be facing the gatekeeper. No, the gatekeeper is the trustee. So I just got to come up some sort of succession planning processes, not a perfect one, at least to start thinking through. Now the trustee is very reasonable because the client haven't died.
Correct.
So you're given say 2-3 years to build up. So at least you must show them that you're building towards that part.
This actually is one of the topic that's high on my mind, Alan. I talk about this with several people already. In fact, this story you shared with me, it's not the first one I hear. I have another user who is a COT, and she worked with a lot of high net worth clients. Yes. And the same question was asked of her, So you do all this planning for me and all that. What if you're not around? Right. But in her case, she actually built around her a team. In her case, yeah. But of course, she belonged to a very rare group of people.
Oh, yes.
But I do see that as Singapore continue to become affluent and all that, right? In fact, there are a lot of people who are millionaires. The stakes indeed can be higher.
Oh, yes.
High. Yeah, can be very high.
Correct. Yes. There's a part. Actually, talk about the millionaire. I got the actual data from the MAS report.
No, really? Share it.
Okay, I guess how many millionaires are there in Singapore in 2020?
No, I do not know.
Okay, 154,800. These are millionaires. Yeah.
Okay.
The next question: how many billionaires are there in Singapore?
I don't know.
45.
45.
45 billionaires. So Singapore is going to be a hub for family office. It's going to be a hub for high net worth individual. We should welcome them now. We should welcome them. Don't see them negatively. We should welcome them because they create jobs.
Yeah, absolutely. Yeah.
But you also need to raise the bar of financial advisor.
Yeah.
There's only so much you can maybe learn by yourself. I think collaboration, the team approach is going to involve, is going to be, the future is going to be.
Yeah.
I mean, everybody, we've only got 24 hours. I mean, is it possible insurance also good, estate planning also good, investment also good, alternate investment also good, real estate also good. I don't think so. I think we are bluffing ourselves.
Yeah.
All right. So therefore, as a financial advisor, we got to understand first what is our professional calling, what really excites you. If it's estate planning, in my case, estate planning, because so be it. Because estate planning, I happens to have a natural inclination, and I feel excited when I study about probate, when I study about effect of finance on death. I don't mind sharing. I am not so keen towards medical insurance. I am not so keen towards general insurance, the fire insurance, the car insurance. Those are important stuff. Those are important. I'm not downplaying that. Just that it's not my professional calling.
Yep.
All right. So I will study around myself. You see, my education is law.
Yeah.
Chartered financial consultant. Even I get myself formally trained in life insurance, CLU. There are not many formally trained life insurance advisors in Singapore, Many can sell, but how many are formally trained now? Let me tell you, only about 2,000 plus. They had a CLU.
In Singapore?
Yes, not many. Our industry is very unique that you don't need to be formally trained. You also can sell the product. And you can be very successful in selling the product.
Yeah.
I mean, so it's like this. The next area I want to venture into is tax. I also got this natural integration on tax. All right. So formally go through the course. This what here.
Yeah.
So investment, I let go a bit. I don't really get myself. I got an investment advisor. All right. So his calling is investment. So I rely on him.
Yeah. So
that's a part.
So Alan, before we move on to the case study, right? I hear you talk about the report. There's this thing called the Lsd ratio, right?
Yes, be careful on video.
No. Hang on. I'm quite educated, at least by you. LSD stands for Liquidity Ratio, Solvency Ratio, and Debt Service Ratio, right?
Yes. Maybe I do a share screen before we are both being misunderstood. I think it's an important part. Yeah. Personally, I'm involved in the lecturing for the Diploma in Financial Planning, the very first program in Singapore. So these are some of the basic skills that we need to educate the financial advisor, which is my responsibility. These are important things because let me just this part. Let me just change the. Let me just okay. All right. Now ratios are important because on the one hand, you have got your balance sheet. You got your asset, all right, and you got your liability, These are all figures. These are all figures. Sometimes all these figures are, let's assume your asset, you got a house that give you say 1 million, and then you got cash and bank, say 500,000. You got loan 800,000. You got a credit card loan, say 10,000. Example. These are figures. Sometimes very difficult for you to draw conclusion and insights. So therefore, ratio, I took some figures on here, I divide by some figure on here. I try to gain certain insights. That's what ratio is all about. So there are among many ratios. There's among many ratios. So among the main ratio for the financial planning practitioner, there are 3 key ratios that you need to help the client to watch out for. You kind of watch out for. So the very first ratio, the first L, is what we call the liquidity ratio. Liquidity ratio. Now, what is this liquidity ratio? Meaning to say that if for whatever reason your source of income is being cut, say COVID-19, you lose your job.
I see.
Say as a result of certain risks, say cancer hits you, you cannot perform as the managing director of your business or cannot perform as well. All right.
Right.
Do you have got sufficient cash or cash equivalent to sustain your household expenses for how many months? So this one, what we use a cash and cash equivalent. What are cash equivalent? So those kind of financial assets, they're very fast. You can liquidate and take the money on.
Like shares, things like that.
No. Shares,
not shares.
Not shares. In Singapore situation, cash are deposit in the bank. I think that's quite understandable. Sure. Cash equivalent is what some of the is a Singapore government savings bond. That one when you sell, you really get back your capital that one. And then the liquidity is there.
I see.
Right? Cash and cash equivalent. All right.
Right.
So is these two part right? You divide by your monthly expenses. Then this one you give certain figures. Say you got a figure 10. example. What does 10 stand for? Stand for 10 months.
Mm.
Means what? If you lose your job now, your cash and cash equivalent, every month you draw, it can last you for 10 months.
I see.
All right. So this is the figure that show you how secure you are if the source of income really hits you. So if you want to go further, there's another ratio called standby liquidity ratio, which also include investments like what Samuel talked about, shares.
Yeah.
All right.
Yeah.
It also can involve insurance policy cash value.
Mm.
All right.
I see.
All right. Those kind of assets that's liquidable for you to draw out on. That's
I
what we
see.
call the liquidity ratio.
I
Now,
see.
OCBC recently done a survey. I think not many Singaporeans have got quite high liquidity ratio because the debt of Singaporean are very high. Because most of this debt go into property. If you got a property and then you got a car, you can find that most people is or great percentage of professional or household, they live from month check to month check. They could make 20,000 income a month, but their debt could be 18,000. That kind of situation is.
I see.
All right. So liquidity ratio is one part that financial advisor need to help client to see
Keep
the
a
trend.
lookout. I think the COVID situation really, it's actually, you think about it, it's really frightening.
It is.
It's like without warning, suddenly an entire industry just became irrelevant. And
Yes.
if that means, in other words, if your liquidity ratio is low,
problem.
Straight away you're in problem already.
Yes, of course.
Yeah.
Another ratio that just now is L. Number 2 is S. S is what? Solvency ratio.
Okay.
So solvency talking about what? If I understand what is solvency, I think I use the word insolvent easier to understand. Insolvent means the debt get pulled back. You're supposed to pay. Are you able to pay? If you can't pay, you don't have sufficient liquidity to pay. You can be insolvent. The outcome of insolvency will be bankruptcy. Right? So solvency is do you have a sufficient asset that you can liquidate to pay off your debts?
I see.
Now this one, I want to say that Singapore must be very proud. We are the only country in the world that go and tell certain financial planning course in other part of the world to say that the way they see is wrong. This made in Singapore. It's truly made in Singapore. Yeah. Now, solvency ratio talking about when the loan is being pulled back, do you have a sufficient asset that you can liquidate to pay off the loan? This is liability. Okay. Normal textbook definition, solvency ratio, they put it as net worth divided by total asset. Total asset.
I see.
That is wrong, no? All right. The net worth means what? Asset minus liability. That's net worth. Why is that so? Because in Singapore, there are certain assets. You can't just liquidate and go and pay off the loan. Of course, the professor in other part of the world are not so happy. He will question me, hey, Alan, who do you think you are? Why do you talk like this? You know, my textbook has been there even before you are born. You are saying I'm wrong. I'm looking at the professor. I say, yes, indeed, you are wrong. All right. Why is that so? Let me explain by facts. Yeah. So, Samuel, you are a Singaporean. You are same year as me. You're 51 years old. You got CPF. Can your CPF be liquidated to pay off your loan or not? Can or not? Samuel, I'm asking you a question. Can you go and take CPF and go and pay off your loan?
Unless you die, right?
Unless you hit number 1. Number 2, property. Okay, in Singapore, property is emotional topic, no, and property is very expensive, no. Is it convenient to liquidate the property to pay off the loan? Say the loan is 1 million.
Depends.
Is it convenient?
If this property is your roof over your head, it will be a problem. Unless it's an extra property, but then again, subjected to market forces,
yes,
right?
Correct.
Yeah.
So the third thing is car. Car, I mean, you liquidate, do you really get the value that you thought you want it to be? If you just force liquidate. Problem. So therefore, based on Singapore situation, CPF, you can't really liquidate and pay off your loan. Property are not convenient, no. So therefore, when you calculate solvency ratio, you could take these two off. But the problem here is if you take the property and CPF off the balance sheet, you will find that most of your client balance sheet is very weak. And that's where financial advisor got to come in. To educate the client.
And there's There's another reality here, isn't it? No? Because you're talking about solvency, you're talking about liability with the bank, right?
Yes, of course.
And the bank don't wait for you.
Of course. So actually,
Your estate may take 3 years to clear. The bank's not
Yes.
going to wait for 3 years, right?
Correct. So if you run through this ratio and you put in the risk of critical illness disability, you can find that most of the clients are actually technically insolvent if he got himself into a critical illness situation. That's opened up a technical opportunity and the reasoning for financial advisor to further go into the critical illness product recommendation.
This is actually very, very interesting topic.
And of course.
And if the financial practitioner carry this well, then there is tremendous opportunity, isn't it?
Yes, of course.
Okay, let me think.
You can see this solvency ratio, and this is made in Singapore. No? This knowledge that I shared with you is made in Singapore.
So
that is why I got so much confidence to telling certain institution in Singapore, let's rewrite the textbook. In
Singapore, but actually it's pushed by you lah. You are the guy to blame lah.
Yes. Hey, Alan. But it's made in Singapore, but it's technical reasoning. You see, so you can't say I'm wrong.
What happened to that conversation you had with this so-called professor then?
Of course, we become good friends. Then he also see my point. No, he didn't see this point because you can't expect him to see this point. He's practicing in United States.
But isn't it similar also in United States? That some of these denominators are the same, isn't it?
Of course. Let me highlight to you. I myself am involved in writing textbook for past 1 year. Well, it was a good outcome, a good experience, but it was a nightmare when I'm writing it. It's not easy to write textbook, no.
Yeah,
but therefore I respect those people who write. But I also beginning because I write, I also understand the problem. Sometimes you don't get the practitioner to write, you got a problem. You won't have the practical aspects coming in. But if you want to get a practitioner to write, a practitioner, his DNA is not trained for writing. It's going to be a nightmare for him. You get what I mean?
Yep.
So therefore I got this rare opportunity in year 20. In fact, started in 2018, then 2019, 2020. I'd be very thankful I'd be given the opportunity so that I can help shape certain things in Singapore. All right, the way we look at financial planning, put in whatever I mentioned here into the textbook So I think I was looking at some social media some AIA advisor is actually posting the textbook. They are very proud of what they read. I feel very happy. At least they are reading my work because they need to take exam, you see, so they could read.
I see.
So these are situations that as a financial advisor, we got to look deeper and understand Singapore situation. The issue is understand Singapore situation. Because most textbooks, they're written, sometimes they use a corporate accounting to just write. And then you turn that into personal finance. There's certain part not there. There's a part.
So if you analyze this solvency ratio, this portion alone, a lot of people would have a lot of topics to talk about.
Yes, it's very serious, no? Technically, you're insolvent. No, I think a few weeks ago, we talked about if you're insolvent, never mind. No, what if accidentally you bankrupt your wife as a result insolvent?
Absolutely.
Yes.
So
So
when you talk about the debt, the liability portion, there is so many that there are actually more than meets the eye. There is that aspect as well. Am I right now?
Yes, of course. That's where the review has to come in very strongly because in the onboarding phase, if you talk too much of all these things, sometimes it can jam out your operating system. I have a heart for financial advisor because sometimes financial advisor, you are being compensated on the product transaction. Let's face the truth.
It's not easy. No, it's not easy. It's really not easy. Yeah.
So therefore, my point is, as you onboard the client, during the review phase, what do you talk about? You're given that seven touch point, the 7 years, no? Because why? If you manage the client 7 years properly, the client is likely to be your client. All right. Why 7 years? Because you got so many things to talk about. No, you got your debt, your investments, your retirement, your estate planning, and child education.
Correct.
There's so many, no. I come out to a structure about 7 years, seven touch point. So therefore, in one of these 7 years, so-called review, if you took on the mindset of if you took on a fiduciary duty mindset onto a client, meaning that what is duty of care. Duty of care of what? The client. Because you say you're professional. Unless you admit you're not professional, then we don't need to continue this conversation. Just sell product. All right. But if you want to say you're professional, so therefore there will be this duty of care. So I got to ask you, hey, your duty of care, what does it mean? Is it just something that you put on the wall? Or is it something that you mean it? If you say you mean it, what is the activity that you actually do to demonstrate what you mean?
See, when the stake is low for the client really don't care. In fact, the numbers that was released by one of the largest company that says that repurchase rate stands at 10%. Right? Of course, this number bears a lot of insights. Right? You can literally write a book about this.
Yes, correct.
But like what you mentioned, the way the market is structured, the fact that the financial planners do not have a basic pay. They cannot keep reselling to the client also. They have to really look for new clients all the time.
Correct.
Right? And again, you have 24 hours. Right? So it's really not easy to carry out this review. Not to mention, there's no proper system.
No, but the good news is that whatever I mentioned, because it's ratio is all about data. Because once you're managing data, it is possible that AI can take over the function. The AI take over function, not to crowd financial advisor out. It's to free up financial advisor more time.
To augment them. To augment them.
More time to bring the message across to the client. Because you don't need to go and do the calculation. All right, there's
we will have one. We will have one session to talk about it. I have a lot to share about this actually. Right?
Yes, correct.
Yeah. So yeah. But I think where the rubber meets the road. You see, when the stake is low for the client, a lot of clients. I mean, again, right? This is heart-to-heart talk, right?
Yes.
This is the real truth on the ground, Clients, a lot of them have been disappointed, right?
Yes.
So if the stake are low, they don't care, right?
Yes, correct.
But if you want if the financial advisor want to really do better, then you inevitably you're just going to come across clients where the stakes are higher.
Correct. So the last ratio, just now I talked about LS, L is liquidity, S is solvency. The last one is debt, debt servicing ratio. Debt servicing ratio means what? The amount of debt that you're payable. Debt payable. Can be per month, can be per year, up to you to divide by your income. Of course, if you calculate per month, your income is per month. But usually people use per year because sometimes you got bonus. Correct? So how much debt you pay per year divided by how much debt, how much income that you have. The debt servicing ratio, if it's cross more than 2/3, is a bit dangerous. So what we call the financial vulnerability. Because there's a Chinese saying, 借来的钱迟早要还. Means the money you borrow, you have to return one. Whether you're alive or dead. That's a part you say.
The Bible also mentioned, right? The lender is the head, the borrower is the tail.
In fact, for the Muslim, according to the Quran, you cannot bury the body unless on the death, before you bury, the debt ought to be settled.
Serious? I didn't know about this.
Otherwise, the soul cannot go to heaven. No, that's serious. No,
that's serious.
Of course. So this situation, debt servicing ratio. The issue here is like this. All right. Now, if you were to say borrow money, you borrow money to buy house is okay lah. What if you also borrow money to buy insurance policy? You borrow money to buy car. About the insurance policy, sometimes you even borrow money to do investments, like buy bonds or what. Nothing wrong in that. There is a specific financial planning design, strategy. But the thing is, sometimes if you borrow money to purchase an insurance policy, what we call premium financing, you actually makes the debt servicing ratio goes up. You actually makes the solvency ratio quite bad because it's more, you're taking more debts. So therefore, this one, the ratio also let the client know that where is it heading. Also let the financial advisor know that whether the financial strategy is going to the right direction.
I see.
You see the part?
I see. And of course, this one LSD.
This LSD.
Maybe you next time change the sequence. DSL
yes,
LSD. Then got a lot of misunderstanding. Right, jokes aside.
Yes, correct.
Now you explain to me what you're explaining. I understand. Of course, I'm also like a layman, right? I'm very sure after we finish this session, I'll forget,
Yeah.
So for the client, this will only be of good effect to them if they themselves also understand all these things. Am I right? So every time they want
yes,
to,
correct.
they will consult this ratio first, or at least call the advisor and say, hey, look, where do I stand? Am I right? Would I be overly exposed if I were to
Yes,
take up this new asset or this loan or whatever?
Yes.
Yeah. Right. So back to the role of the financial advisor. In fact, actually, the financial advisor's role indeed is a very meaningful one, actually. Yeah, it's actually a very meaningful one. So, yeah, okay, guys, I think, Alan, let's go right into the case studies. Yeah.
Okay.
Okay.
Yeah. Okay.
Hey, bro, I pause for a while.
Okay.
Short while. Pause for a while.
Okay,
Let me turn off this annoying notification. I forgot to turn off. Okay. Okay, like Alan, please. Yeah.
Okay.
Continue.
Can
Let's
come.
go.
All right. Today gonna present one case study. I think is good for a financial advisor to know. Has to do with estate planning.
Right.
Let's do that part. Okay. So just want to use this particular case to emphasize some importance of as the impact of death onto a client's estate. All right. So if it's not being planned properly, the outcome is very terrible. The outcome is very terrible. So in 2012, I believe most of us can vividly remember there was a horrific road accident involving a Ferrari and a taxi near Bugis Junction. All right. So what happened is that the Ferrari, he beat a few traffic lights. And then rammed into a taxi. And then the taxi driver was killed on the spot. And then inside the taxi there is a passenger, a 41-year-old single lady, just Japanese. She also got killed. And the Ferrari driver also, he himself he passed away. He died in the accident as well. So he left behind 8.1 million worth of estate. Insurance policy. Out of this 8.1, 2.8 million come from insurance policy. But the policy did not do any nomination nor estate planning, and therefore the situation is quite bad. Right? So this is a situation in the graphical matter. Right? So that I share this, and therefore this analysis is being captured on video so that for future usage for any advisor that is keen in this analysis or research. Now the estate of Machi in this situation, Machi is from an emerging country. I think he become a Singapore PR. Right, he has got a property, cash, other asset, life insurance policy. All right, now he passed away prematurely, left behind 8.1 million, intestate because he did not leave behind any will. Now his family structure, as you can see, because he has got children, so therefore he needs to have two administrators. One is the wife, the other one is his elderly mother. All right, so he got a wife. His family structure, he got a wife, and he got an elderly mother.
Oh, is there a need like that for two administrator? Is it?
Yes.
Is it by law?
Yes, it is because of this one. You have got children.
I see.
You have got children. The reason being what you want to ensure that the whatever is due for the children one is so-called being accountable or answerable by somebody lah. All right. So you cannot leave it to one you to two person All right. Okay. Now, so this situation. Now the thing is, he killed somebody, So these are the people that he killed, and then or he injured the deceased taxi driver's estate, the passenger, and there's also motor biker get damaged. He did die, but he got injured, right? On the night of the accident, there's a lady companion sitting beside him in the Ferrari. Right? The relationship between them, I mean, we are not here to judge, but she's there. She got herself injured. The girlfriend got injured. And then she also knocked down a lot of public property, like the traffic lights and all this. You're not going to repair that.
I see.
So all these are what we call estate creditors, what we call contingent liabilities. Contingent liabilities these estate creditors will launch a claim onto the estate. All right. So therefore, after everything finish, the remainder asset then flow to the wife and the children.
So in this case, based on intestate law, right? 50% will go to the wife, 50% to the children.
Yes.
Is that right?
Let me just throw you some spana. Samuel, the wife at the point of the husband's death was heavily pregnant with the third child inside her stomach.
Third child, okay.
Third child, but inside her stomach. So does the child has got inheritance rights or not?
Luckily, I studied this, Alan. Have lah.
As
long as he's pregnant, but must be born.
Yeah, must be born alive.
Yeah.
So it's Section 6 of the Intestate Succession Act. Section 6 there. They did say that the child inside the mother's womb got inheritance rights, but must born alive.
Actually, Alan.
Yes.
Another spana caught my eye actually.
Yes, come.
This is the part I didn't know. If let's say the wife and the mother intestate, right, and the law actually have to appoint these two person, am I right?
Yes.
There can be a problem here also. If the wife and the mother don't get along,
problem.
Wow,
in
big
this
problem,
case,
right?
In this case, the wife and the mother don't get along.
Seriously? Okay.
No, why? No, can you see, Samuel? Can you see something is wrong in this part here? Now, let's assume that this 8.1 million still got some remainder amount. So 50% of whatever remainder amount goes to the wife. The other 50% go to the children.
Right.
And the mother.
So can become another lawsuit.
Yes, the mother actually zero. So in this situation, the mother has got the legal responsibility of being a co-administrator. Being co-administrator got responsibility legally. That means you don't do things well, people can sue you. Okay, number one. But yet again, the mother don't have inheritance rights. Is this fair?
Of course, it's a big problem.
Of course. I need to do the thing because by law I have to do. Then not only that, after I do already, the inheritance I got zero. I got to ask people for money. Ask who? Ask your former daughter-in-law. Ask primarily your former daughter-in-law. Can she don't give? Legally she can, no?
Can.
You can, no? Legally she can fight back, no? She can tell them that, hey, your son did not bring me pride, no. Your son actually died in a very bring shame to me, no. I am pregnant with my third child, with his third child, no. In the night, no. In the night he go out have fun, and then there's somebody beside him, not it's a lady beside him, no, in that hour, no. And whole Singapore know. You see the part?
Yeah.
You see the potential issue? That's why I always keep mentioning that as a client, when certain things happen, do you have a sufficient capital income liquidity to discharge your duty as a son, as a father, and as a husband? In this situation, his discharge of his duty as a son to his elderly mother is
actually we should enshrine this duty statement, Alan. Which is actually you said the last session you said that the word duty is like maybe too heavy, but actually no, I disagree. Actually it's not. Unless we are totally irresponsible, right?
Yeah.
There's no sense of responsibility, But other than that, definitely there's duty. There's always a sense of duty. There's and
there's a part. Okay. So therefore, this is the current situation and we study case study. But with case study, we could study what could have been done. What could have been done. So this, what could have been done could be like that, no? Very simple, no? Of course, I dare not say this is a perfect solution, all right? Because many things can be done on the hindsight. But we're studying this not to make fun of people, but we're studying this to give to make us better in terms of insights. No, I want to qualify. We are not making fun of Marty or what. We are not. All right. It's unfortunate that he passed away in that kind of circumstances. All right. But as a financial advisor, let's study some of the insights. Now, let's assuming that before he passed away, Marty passed away, he had got a financial advisor that went through the scenario with him. Scenario is what? Death. Say if you by understanding of his family structure, number one, and number two, the way he owns his asset, and number three, the way he arranged his estate distribution. Okay. So The financial advisor could have pointed out that there will be some inconvenient situation that you need two administrator. No. Now, this co-administrator thing could have been avoided. You just simply have a will can already, no, because you can identify an executor.
The executor, correct.
You don't need the co-administrator. That's a part.
Correct.
Number two, you take a look at life insurance, which is close to all our heart. The life insurance should not be going to intestate. Right? Yeah. It's 2.8 million sum assured total. You could use up
quite a lot.
The nomination framework to make it trust nomination. So that the entire sum assured is not part of the estate debt. So the entire 2.8 million can flow to the wife and the children.
Directly,
yes. And you can have some sort of assignment of policy, assign some amount to the mother. So the insurance policy, this part here, you do it properly, can be out of the probate. Can be out of the probate. Because the probate is where your estate creditor will sue.
Right.
There's a part, you see.
But this is the part, question.
Yes.
The will can also mention about how the proceeds of this policy should be used. Am I right? Let's say, for example, he wants to give 500,000 to the mother. But because the 2.8 million, because it's a trust policy, don't have to. It's almost once the death certificate is out, immediately can be paid to the wife, because the wife is nominated, right? Let's say. So the money goes to the wife. There could still be a situation that the wife hold the money and say, would there be a situation like that? That no, I don't think I want to give the 500,000 to the mother.
Possible, because when you do a trust nomination, the money will go to the wife. Or you're talking about the money go through the will.
Yeah, that's the part.
Oh yes, but it's not wrong for insurance proceed to go through the will. But just that if you go through the will, this one still comes first.
Of course. So you go to the wife, but of course, in which case, if there's a dispute, then you go to court, basically, right? Executor have very limited power also, right? He's only like a custodian, right?
Yeah, he is a trustee and also a legal representative of the estate, He got the fiduciary duty to clear the estate as fast as possible. Right. Yeah. So therefore, maybe I just share with you one.
He cannot insist for the wife to say give the 500,000 to the mother.
Cannot because if your will never say you can't insist, or the wife got the right of not to give. So therefore, this is can you see the diagram here? Samuel, can you see the diagram? The red box in the life insurance, you can see. Tools and technique for wealth transfer. This is what I mean. Your life insurance policy can be out of the probate process. It can be used Section 49L, Section 49M, or you put your life policy into a trust.
So in this case, it's totally out of the will. Am I right now?
Yes. Correct.
Out of the will means out of the purview of the executor already.
Yes, correct. So say you assign a policy to a trust. The trust can say the trustee will empower and claim the policy, say the sum assured 1 million. And 1 million, say every year 100,000 give to the mother. Example.
So if he wants to make sure that there is certain amount of money go to the mother, right? Then it has to be through another means really. The amount that goes directly to the wife, to expect the wife surely will give the 500,000. Could be a long stretch. I mean,
no, of course. You come to estate plan, you normally don't do that. You already pass the money to a trustee.
I see.
Right. Well, you can't pass to family members and hope the family members pass on to the other person. Not very difficult, They're very good because there's no legal enforcement, because I receive the money that money is for me. I am not a trustee to hold the money for someone else. All right.
Right.
So we can't plan based on goodwill. I mean, we plan must put some certainty on it. That's the situation. All right. So setting our trust and all those things in today's term is not that expensive. I think it become a very accessible even for mass market. Just get a good trustee manager. He will brief you what to do. All right.
I see.
These are situations. So this is what I mean by the tools and technique of a wealth transfer. Will is just one technique on it. You see life insurance or cash.
So the learning points for this case study, I think the main one It's also because I've gone through the previous sessions. The topic of contingent liability
yes,
became quite prominent in my mind.
yes, of course.
And I have to admit that since this is really heart-to-heart talk, I don't mind telling you that I really didn't really know the view that the estate creditors actually have first right.
Oh, yes, they got first right because the will do not have estate protection.
And again, I wonder how many people, consumers out there actually know this also.
Yes, I think, yeah, correct. So there is a need for financial advisor, not just know the knowledge, but to be able to know how to present, how to bring out the insights to the client. Knowledge is not enough.
It's again a very inconvenient topic, isn't it, Alan? Because they don't, to do the will with the client will require time. It will require conversation and all that, right? But they are not handsomely compensated for doing this part.
No. So the issue here is that that maybe perhaps there is no need to do this during your first meeting with the client. The first meeting with a client, for practical purposes, if some advisor is not skillful enough, it can be a simple product sales. Nothing wrong with that. It can be in a roadshow, or this situation.
First engagement,
just a product sale. But the thing is, when you onboard the client, the subsequent review during the 7 years, you got to do some sort of this kind of scenario review. What if this happen? How will the asset flow? Asset flow to who? Now the knowledge technique, actually, the knowledge is not difficult. No, I think Galileo. I went through with Samuel over the weekend. There's this phrase by Galileo. Galileo is that scientist, I think, a few hundred years ago. Telling the church that it's not
the Earth is round.
It's not the planet revolve around the Earth. No, the Earth actually revolve around the sun. Because he says that actually those days the
heresy. It was considered heresy.
Those administrators not that happy with him. No, I think they killed him. If I'm not wrong. So he actually said one statement. This the truth is not difficult to understand. It's quite simple. But the problem is you discover the truth. I think it's the process of discovering the truth. That is the accent. That's a tough part. Once you discover the truth, actually quite simple. So therefore, it's also one of my so-called purpose statement of having this case study being recorded on video. That maybe since I've done this analysis, I just share with you. So you don't need to go through that analysis part by diagram form. So you see before, after, what could have been done, kind of situation.
Yeah.
All right. So when I first started in the industry, I don't have all this. I didn't know this. I hope I can have all this, but don't have. Don't have. So it's
indeed
accessible.
Indeed, very, very insightful. I always tell you, right, I'm the hybrid guy over here, right? So
correct.
Because I had experience in the industry, I've been in the industry for so long. But yet, at the same time, I'm a consumer, right? Sometimes as an advisor, not easy for you to see the part of the consumer. It's not easy. So I happen to be this hybrid guy over here that I can, every time my feeling is really towards the advisor, at the same time also towards the consumer, right?
Correct.
And not only does the advisor need to carry this topic, I really believe in that. The consumer need to be educated. Consumer need to be educated. Like I said, confirm, 6 p.m. later, now it's 3 plus. 6 p.m. later, I'll forget 80% of what you said. Actually, interestingly, Alan, some of the things you shared, this is session 7, right? You shared session 1, session 2, right? When you said some things, it just went in like that, one ear go out the other ear. Sometimes it was like that. It took a few sessions for me to, for some of these facts of truth to sink in. And then you think about it more. It took a while, actually. It's not something that just happened just like that, just because, people spend 1 hour listening to this, and then you walk away, you will straight away have that realization. I think it's going to take a while.
Correct. It's going to take a while. Certainly.
So, So okay, I think we have come to the hour mark.
Yes, correct.
And yeah, so once again, really thank you for this time. But guys, that of course while we do this, I managed to convince Alan, right, to work together with HQ to put this repository, for us to host this repository. And we are not just hosting the repository for the sake of it. We're going to put data structure and a lot of technology behind this whole thing. Okay. So it's going to happen in 2021. And I am very excited about this, and including our stakeholders. Our whole team is excited about this, and I hope that you guys will be as well, because technology is really going to play a big part. And future session, Alan, we will plan something. One of the topic that we really want to talk about and take a deeper dive is the question of how does this future financial practitioner, advisor, consultant, how does this person look like? Okay, how will this person operate? The relevant ones in the future. So this is, something that a project we really want to do. You want to really make this projection, right? And the thing is that we don't have to be 100% accurate, no? We just need to be 52, 53% accurate. In fact, the casino just need that odd to beat you. About 53%.
Correct.
And we don't need to be, in fact, if you are 50%, I think people need to really take it seriously. Okay.
Correct.
Right. So guys, really, let's look forward to that. Okay. So Alan, once again, thank you so much. Thank you so much.
Bye-bye.
Please.
Bye-bye.
Right.
Bye-bye.
Cheers.
Take care.
Stay safe, guys.
Yes, bye-bye.
Okay. Bye.